I never used to think of this as kind of a either or type thing. I just sort of said there's two different worlds. There's the investing world and there's the casino gambling world, right? Just the way you can come and be Warren Buffett and then, buy different stocks, or you can take your money and go to Vegas and go sit at the blackjack table. Just different behaviors, and they both exist. And so we just kind of viewed a lot of the meme coin trading as the modern day version of, sports betting or sort of going to the casinos. It's just, on your phone, on an app, and it's a social experience. I think that's the difference we noticed this time around. It was less of a social experience in 21. It's more of a social experience today. So, our general view was this stuff is here to stay, but we can't partake in that. We just want to focus on high quality projects that will onboard users, solve a real need in the world, and as a result, generate economic returns. That's kind of what we're looking for.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic from 4RC. Today's show features Pranav Kanade, portfolio manager for digital assets at VanEck, as we dig into the realities of investing in crypto this cycle. In this episode, we break down why altcoins have underperformed so far, what we can learn from the few that have bucked the trend, and where new opportunities are emerging. We also discuss the impact of recent stablecoin legislation on equities, plus the latest developments in ETFs for major crypto assets. But before we do, just a quick word from our sponsors who make the Edge Podcast possible. Hey folks, I want to tell you a bit about our sponsor, HOURGLASS, the protocol unlocking liquidity for time-bound tokens. With HOURGLASS Boost, you can time boost your assets and earn time-bound tokens that maximize your yield. Alternatively, HOURGLASS also enables leveraged airdrop farming, where you can get over 150x leverage and 10% more points than anywhere else in DeFi. Plus, thanks to their slippage-free market design, you can secure bigger airdrops at better prices. To learn more about HOURGLASS, go to hourglass.com. Launching your blockchain in months? That's so 2020. Launch your network in minutes with TANSSI infrastructure. Restaked security through SYMBIOTIC, plus full customization just a few clicks away. It's 2025. Build smarter, scale faster. Visit tanssi.network to get started. Hey folks, I wanted to tell you a bit about our sponsor, PYTH Oracles, your go-to source for smarter data to power smarter contracts. PYTH delivers real-time market data for crypto, equities, FX, and commodities to over 80 blockchains. With 120 plus major market participants like Jane Street, Binance, and CBOE, PYTH ensures secure, low-latency feeds trusted by 430 DeFi apps. You can learn more about PYTH by going to pyth.network, and thanks to the PYTH community for supporting us here at the Edge Podcast and Edge newsletter. Overwhelmed trying to manage your crypto and DeFi investments? Meet iYIELD, a free financial planning tool for crypto natives and yield farmers. iYIELD's dashboard compares returns from your DeFi positions side by side, providing clarity to help you make better decisions. iYIELD supports a growing list of over 16,000 tokens and 40 of the top DeFi and staking protocols across 17 blockchains, including Ethereum L2s. The best part is that iYIELD is 100% free, anonymous, and there are no ads. Check out iYIELD.com today to take control of your financial future. Meet Definitive, the most advanced on-chain trading platform across every chain. Built by Coinbase alumni, Definitive's institutional-grade features lets anyone trade like a pro, featuring advanced order types like limit, TWAP, and stop loss, gasless trading, one-time approvals, and soon cross-chain swaps for multi-chain EVM and Solana. Definitive routes your orders through every liquidity pool to get you the best price on every trade. The alpha is on-chain. Trade it instantly on Definitive. For Edge Podcast listeners, enjoy zero trading fees on your first $50,000 in volume at defidad.definitive.fi.
Bitcoin Layer 2s are everywhere, but Goat Network is different. We're the first to use decentralized sequencers, letting both Bitcoin and Dogecoin secure our network while earning native yield. No nonsense, just your assets working smarter. Our early supporters got it, with over 8 million committed in December alone and already earning returns. Next up, mainnet launch in Q1 of 2025. Goat Network, where Bitcoin scaling meets real yield. Visit goat.network Get involved and start earning sustainable yield.
All right, let's introduce Pranav Kanade, a portfolio manager for digital assets at VanEck. Pranav, welcome to the Edge podcast. How are you doing?
Living the dream, guys. How are you?
Yeah, thank you for joining us. Today, we're going to talk with you about some of the macro conditions within crypto. So I think specifically we want to talk about why have altcoins sucked so much this cycle? What can we learn from the alts that have performed well? And then also want to talk to you about your thoughts on what are opportunities that we might identify with stablecoin regulation coming. So that's been a really exciting development, I think, since the US presidential election. Let's talk a little bit more about like what you do at VanEck. Would also just love to give an overview of VanEck in case folks aren't familiar with like such a prominent name in the space. So yeah, anyways, kick us off with a little bit more there.
Yeah, no, maybe I can start with my personal background and then I'll kind of weave it into VanEck. So I spent 11 plus years in TradFi. I was a portfolio manager at Millennium prior to coming to VanEck. I was primarily looking at distressed credit and public equities and high yield credit throughout my time in TradFi. I was introduced to crypto, I would say mostly in 2017. I was, familiar with Bitcoin prior to that, but really everything else in 2017, it was pretty fascinating just to see capital formation through ICOs at the time work on chain without any intermediaries. And a lot of folks raised a lot of capital then. And I generally think of the world in probabilities. And I looked at all the things people are raising capital for, prediction markets, some DeFi things, all this stuff in 17. And I kind of said, what are the odds that this becomes something in the mainstream one day where billions of people could be using these products? And at the time, I put a very low probability primarily because there was nothing truly usable yet. Things started to ship in 2018. Generally thought the products that were coming to market were not very user-friendly, were sort of super slow and clunky to use. And I put the odds that this thing kind of goes mainstream relatively low. Still doing my TradFi job. 2020, 2021 comes around. I start playing around with things like Uniswap and Aave that were just sort of coming to market at the time. And then it kind of became clear to me that the step function changes on the sort of quality of products were there and it was happening. And you could envision sort of a time in the distant future where this infrastructure would essentially be the backbone of the financial system. But more importantly, tokens and well-designed tokens were going to be better capital formation tools than stocks and bonds. So I live in the world of stocks and bonds. And I looked at a lot of tokens and I said, these things can be a better form of those existing instruments for the investor, but also for the business that is sort of doing the thing they're doing. And essentially, without naming it this way, I underwrote that tokenized equities were going to be the killer product that comes on blockchains one day. And we're not going to try and distinguish between, let's just say, blockchain native businesses and non-blockchain businesses. They're all just going to have a tokenized equity one day that will live on chain, and could live off chain as well, but primarily will live on chain. And I think as that sort of would play out, there's going to be sort of market cycles and ebbs and flows of things that people will find interesting. But ultimately, coming from my background and having followed crypto for a long time, we thought, I was well suited to sort of build a strategy around liquid tokens, and sort of token strategies that ultimately could now sort of translate what's happening to a audience that is unfamiliar with the space. So as I was thinking about what's the best way to do it, my conclusion really was, in 2020, 2021, in that time frame, one of the big problems investors in the space had was a lack of institutional trust. And my realization was, I want to partner with a large organization that has built sort of a long track record, history, pedigree in trust, and then sort of, have a strategy that sort of sits within that. So I met Jan VanEck, who is the CEO of VanEck, in 21. I really articulated the strategy as the following, which is, coming from TradFi, I was a big believer and sort of fan of Bill Ackman running Pershing Square and how he manages Pershing Square. And I said, we should do Pershing Square for tokens. That's kind of this sort of start, one-liner of what we were trying to do. And so we got this going in 2022. So VanEck is today $110 plus billion asset manager, mostly in the ETF business, actively managed and passive products. About 2.5-3 billion of that 110 plus in assets are in crypto and crypto related strategies. Most that are again passive, ETPs in Europe, ETFs in the US, and then there are a couple of actively managed strategies separate within that 2.5 billion or so. So one of them is the liquid token strategy that I manage. We say it's liquid tokens, but we're kind of agnostic. We do tokens and public equities in our strategy. And then we have a venture strategy as well that focuses on pre-seed and seed venture. And we also have a actively managed sort of smart contract leader strategy as well. So we have a couple of different things happening. But just think of us as, a large asset manager, with the one nuance being the entire business is privately held. It's not a public company, which, allows you to take some risks that other public company asset managers might not be able to take.
Pranav, can I just key in on that to make sure I kind of understand the structure here? So with this strategy that you manage, do outside investors buy into that strategy, or is that like a wealth strategy that you're just doing like prop capital within VanEck? Can you just kind of delineate like what type of structure?
So we run a hedge fund structure. Again, I have to just be careful in what I'm allowed to say. I'm not allowed to market it, in the public domain, but you could just Google my name and VanEck and you'll see more details about our strategy there. But it's primarily meant for qualified purchasers, so folks with, I think it was either $2 or $5 million in net worth. I can't remember the qualified purchaser requirements. It's really meant for sophisticated investors. But yeah, it's a hedge fund strategy.
So what's like a day in the life of Pranav look like? Are you just like the rest of us? Do you open Twitter, go to CoinGecko, check prices? Like maybe just kind of walk us through, what you do in a regular typical day.
Yeah, so I probably get up super early, 5:30, 6 o'clock. We have a team in Europe, so those guys have been kind of up and running for several hours before I am. The first thing I probably do is scroll X. Thankfully set up my For You or I guess like the custom pages to sort of filter out for some good news flow and try and understand what is essentially gaining mind share or keeping mind share that day in the crypto markets. The next thing I probably do is I'm a big metrics guy. So when we actually started the strategy, we sort of set out there what are some sort of North Star metrics that we care about as we sort of run our business. And the couple of ones I primarily laid out there was, the following, which is 5 billion people on the planet have an internet connection. 400 million people of the 5 billion own Bitcoin on some centralized exchange or in self-custody or wherever. And when we started the strategy, the number of on-chain users of applications were somewhere between 5 to 10 million. Today, it's probably 20 to 50 million, depending on how you count redundant wallets and things like that. But the metric I care about the most is monthly active users of applications on blockchains, on public blockchains. So I start by tracking metrics like that, right? I track other stuff like daily fees, what's generating those fees across a variety of L1s, which applications are being used, why. So we have a set of dashboards we've kind of internally built that I would say give us a pulse of, let's just say, crypto market status, like where we are in adoption, and then pairs that with market structure, which is, what's happening with prices, but also like what's happening under the hood in terms of leverage, funding rates, those types of things. So it really just a quick snapshot of where we are on any given day. And that allows me to sort of formulate opportunities that we could see and then sort of how we should manage risk.
Pranav, when you mentioned tools, you also mentioned Mindshare. I'm curious, do you guys use Kaito, or do you have any thoughts on Kaito and using that for like this new InfoFi, if you want to call that, in the space?
We do. We do have a Kaito subscription. I think the Mindshare thing is kind of interesting. One of the things I tell founders that we work with is the following, which is, this might get into our altcoin story, so we might go back and forth. But one of the things I say is, where we are today, there's not a substantial amount of net new money coming into the asset class. There might be net new money coming into Bitcoin, but not everything else outside of Bitcoin. So it is a PvP environment. And in that PvP environment, the largest participant is your retail investor. So folks like us, we're not big compared to how big the retail audience is. Crypto historically has always been a retail asset class, continues to be a retail asset class. And your average retail investor is constantly bombarded with new stuff to allocate capital and mind share to, that forces them to obviously sell the stuff they own, right? So you own a good asset. Someone is always trying to convince you on Twitter, hey, sell whatever you have and buy this thing that I'm trying to promote to you. So as, let's just say, quality founders that are building this space, you want to think about, how do I get mind share, but also retain mind share for that retail audience, so that, the underlying token that supports my product continues to perform well. So we use mind share in that context. We sort of look at, we have a grid. So we, for all of our positions and the positions we don't have, we've essentially identified 9 factors that we think kind of matter, and we have weighted each factor. And one of the larger factors there is increasing mind share. Do I believe this project will increase its mind share in the pie that's out there in the future?
Pranav, some of those internal dashboards that you guys use sound pretty interesting. I'm curious, are those totally internal? Would you ever open those up to the public, or are they already and I'm just not aware?
So a lot of it is actually just piecing together what's available out there and then just sort of filtering for what's relevant, right? So I'll give you an example. Obviously, Solana has been the dominant driver of let's just say, new users in the past 12 months. A lot of these folks are, getting the moonshot up and trading some meme coins. I generally want to know on a given day how much fees are being generated on Solana, what's the makeup of that between priority fees and tips, how many users are actually generating those fees, which apps are generating those fees, those types of things. Like the Blockworks guys have done a phenomenal job putting out a dashboard for that, where you have to just be a subscriber for that product. While for some other chains or for some other apps, the Artemis guys have done a really good job putting that together, and you can kind of do your own custom dashboards within that environment. So one of the things we've done is, for different things we're looking for, there's different stuff we've built, but that's leveraging the existing tools in the market.
I think this is a good segue actually for us to start to talk about what's been different this cycle, this Bitcoin 4-year cycle with altcoins. So maybe first, in case listeners don't understand what we're referencing, what do you think has been different this cycle? And then let's talk about why we're clearly all a little disappointed or upset with the performance of altcoins.
So it's actually interesting. So maybe to level set some expectations for folks. We've only tracked this since June of 2022 because that's when our strategy started. So just, I'm using that as a benchmark. I believe the day we started our strategy, Bitcoin was at around 19K. So obviously, since then, the price of Bitcoin has gone up north of 4x. And we have a separate index that we track called Equal Weight 100, which is, again, putting a 1% weight across all tokens, the top 100 tokens, and then rebalancing that portfolio every quarter, right? That gives you a good sample of how the altcoin market is done in the same time frame. And that benchmark, as of right now, is up 24%. So Bitcoin's up 4x. And if you just bought every alt in the top 100, put an equal weight, didn't think too much about it, you've done very, very poorly relative to Bitcoin. And that's kind of what we mean by why have altcoins kind of sucked, right? Historically, what we've seen is when, Bitcoin goes up 4x, the altcoin market should perform much, much better than Bitcoin, because there's a capital rotation out of Bitcoin into these alts, and Bitcoin dominance goes down and so on, right? But in the time frame I'm talking about, Bitcoin dominance, I believe, has gone from 42% to as much as 60+%. So one of the things we're sort of talking about as we say, what has driven this new market structure that didn't exist in prior cycles is this dynamic that you aren't seeing altcoins perform like you normally would. And then we can kind of get into why that is, or what our hypothesis and why that is. But maybe I'll pause there.
This episode is brought to you by Mantle, the ultimate Ethereum L2 for builders. With over $2.16 billion in TVL, Mantle powers multi-billion-dollar yield-bearing assets like CMETH and FBTC, driving sustainable growth and capital efficiency. Plus, Mantle offers a unique reward station for airdropping different tokens to MNT holders, including one ongoing campaign for 4 million Athena tokens and another for 570,000 Eigen. To learn more, go to mantle.xyz, and thanks to Mantle for supporting us at the Edge Podcast and Edge newsletter.
Yeah, why don't we just kind of get into your hypothesis then? What are you seeing at VanEck for this reason?
Yeah, so I think I'll construct a story and tell me if you want to unpack parts of it or if something doesn't make sense to you. But if you kind of go back to last cycle, which is 2020 and 2021, you had sort of Bitcoin performance kick off, but then really past after like January, February of 21, it was really like a lot of different alts, right? You had this big move in Ethereum, and you had this big move in Solana. You had, other tokens like Luna and whatever else that drove so much performance. And that performance told the institutional allocator community at the time, hey, venture is where all these returns are, right? Because imagine if you did the seed round in Solana or Luna or whatever, one of these things, and you had these crazy 100x type returns. That told the allocators, hey, I should now go invest in a bunch of venture funds that chase the next Solana and chase the next, Avalanche or whatever token that did really well that cycle. Part of the reason all these alts in 2021 did so well was because there was more demand and less supply. So there's not a ton of new coins you could allocate to. And you had this huge influx of capital coming in from retail, which were, byproduct of stimmy checks and so on, right? So you had crazy demand and very little supply, and you had this crazy performance, which then forced the institutional allocator community, or not forced, but, got them to go allocate into venture. And I believe something like $40 billion plus was allocated to that pre-seed seed venture strategies at the time. Now, all those projects that got money in 21 and into 22 decided to launch a whole bunch of tokens in sort of the early part of, the late part of 23 and all the way through 24. At the same time, the ones that launched even before that had begun their token investing. Most of these tokens have, typically a 1-year lock, and then the investors begin to invest. So a lot of this 40 billion of supply at market prices were, 200, 300, 400 billion, because they all open up with crazy market caps and super high FTVs because of a low float. So essentially you have a ton of supply from that last cycle that's coming to market. Most of these, to be honest, are kind of useless projects. Like, they just show you a great story and narrative. They use a bunch of jargon. Like, none of it makes any sense. I'm like, who's using this stuff? Well, reality is nobody using this stuff. It's just a bunch of fancy writing. And this whole thing has like an inflated crazy market cap. And that's on the supply side. On the demand side, you didn't have the same institutional capital coming into the liquid market cap. The liquid space, it's all gone into the venture space. So you have a ton of supply coming in on one side, and then the demand has kind of been static. Retail, in my opinion, hasn't come back to the same extent like it was in 21. And the retail that has come into crypto so far kind of said, look, you know what? I don't want to get dumped on by the VCs. Like, I've seen this play out before. I saw it in 21. I'm going to go play a different game here that will allow me to sort of hit returns faster. And that's kind of the meme coin game. So all the retail capital can essentially gravitate towards meme coins. So I would say two things that are happening here, right? Which is oversupply that continues to be a problem, and then the marginal demand that does exist has primarily gone into meme coins, and then there's probably a little bit of new incremental demand that's come in, and that's all gone into Bitcoin. So like this sort of, let's just say, quality projects that have tokens have just kind of been left in no man's land.
So I'm curious, do you still see any opportunity among like the meme coin sector? Because I think at first it was a sector that was getting ignored, and then the returns for a few became so great. People, brag about those returns, even though I swear you could look at the aggregate return across all those different folks. And again, it's a very small sliver of folks that did well. This wasn't like a 2017 cycle where the whole crypto market cap is continually growing, and you basically could just be exposed to a basket of tokens back then, and you more than likely would see your portfolio continue to grow. It was very rare that you would be investing in a token that like actually went to zero or near zero overnight. Now we're at a point where we do have a meme coin market where, to your point, there's so much supply out there that it's just fast money chasing the next shiny object, which, by the way, we're recording this, I think, like a day or two after we just had this whole like implosion over like the Libra token. So, which has been seemingly like the final straw for a lot of folks. Seems like frustration is finally boiled over. So anyways, my original question was, do you see opportunity in meme coins, or do we see a return to fundamentals sooner?
So I never used to think of this as kind of a either or type thing. I just sort of said there's two different worlds. There's the investing world and there's the casino gambling world, right? Just the way you can come and be Warren Buffett and then, buy different stocks, or you can take your money and go to Vegas and go sit at the blackjack table. Just different behaviors, and they both exist. And so we just kind of viewed a lot of the meme coin trading as the modern day version of, sports betting or sort of going to the casinos. It's just, on your phone, on an app, and it's a social experience. I think that's the difference we noticed this time around. It was less of a social experience in 21. It's more of a social experience today. So, our general view was this stuff is here to stay, but we can't partake in that. We just want to focus on high quality projects that will onboard users, solve a real need in the world, and as a result, generate economic returns. That's kind of what we're looking for. Now, everything that's happened in the last couple of days, the way I would articulate it is, I think it might put a pause to the casino activity for the near future, because the average people going to the casino in this case are starting to realize the casino might be rigged. So if you thought Vegas was completely rigged and you were just being cheated every day, then maybe you don't go to Vegas anymore, right? No, everyone knows the odds are marginally in the favor of the house. Everyone knows that when you go to Vegas. But if someone said to you, so I was looking at the data from Pump Fund, someone posted, it was something like 60% of meme coin traders have lost money. It's a lot of people, right? And so, I would think things have to clean up in that world before maybe the gambling element comes back.
So then kind of getting back to the alts then, we've clearly established that this cycle has been totally different. There's been a ton of dispersion. What can we learn from alts that have done well? If you were to kind of dissect the singular names here and there that seem to be bucking this trend, or staying with Bitcoin, or even outcompeting Bitcoin, what do these look like, and what's fueling that?
So I go back to the non-speculative people that are sort of looking at tokens today, and I would probably put you guys in that category, but I put myself in that category, obviously. And I ask, what do I look for? I want to allocate capital to founders who are building great products, and that I can trust the founder that they're not going to, rug me or cheat me somehow or do something shady, hyper-transparent founders. Because the one thing that's generally scarce in the world of tokens is trust, or trustworthy founders. So I think the secret sauce really is great founders with great product with a lot of trust. And so if you could start with those things as a baseline, then the universe is pretty small. And then from that, you can then ask, what are the properties around the token that would make it interesting? And the one obvious one is, in the world of oversupply of tokens and a lack of demand, if you can create demand for your token, i.e. through organic means, right? As in people are using your product, they're paying fees to use your product, that those fees are somehow ending up in the form of reducing supply of that token through some burn or buyback mechanism. Now, again, the question is what does the regulatory environment permit, and is that allowed? But to the extent that is allowed and high quality projects can buy back their own token, that creates a natural buyer for that token itself that gives people the confidence and comfort to own that thing and not have to think about it constantly. So I think that's kind of the general properties we look for, which is great product, trust, and a pretty clean token supply-demand picture.
Yeah, I'd say we're all in pretty similar boat on this call. I think those are great points. So then kind of closing this altcoin segment of the conversation, do you think it's a total myth that we'll have one of these 2021, 2017 type, rising tide lifts all boats types of effects in the altcoin sector? Is that gone, do you think? Or do you think there could be sufficient liquidity injection, maybe a ton more liquid funds come online to kind of fuel that sort of speculation again? And do we even want it, I guess? I think are we maybe moving into a better future not having that scenario play out?
So anything's possible. One way that could come to fruition is, and I think, by the way, the issue is not a lack of liquid fund strategies in the space. A lot of people want to do a liquid fund, right? It's a lack of people wanting to allocate to those people. So then you kind of work upstream and say, why don't people want to allocate? The most common, there's two very common reasons people have come up with. One is the volatility, right? Your traditional institutional allocator is not used to a strategy going up and down 25% a month and having to explain that to a whole bunch of other people who don't really understand crypto, right? If you just picture these organizations that have lots of capital to allocate, they're typically allocating to, private credit, sort of this single yielding strategies, very low volatility, or they're allocating to private equity, they're allocating to venture, which again, none of these show volatility. If they're allocating to equity strategies, they're typically buying things that have the volatility profile of the S&P 500. So crypto is just like this highly volatile animal. And at the same time, these organizations are places where decisions are made by committee, and you have several members of these committees that don't understand what crypto is about. And so you kind of pair the volatility with that sort of lack of understanding. People just get afraid and they say, I don't want to touch this stuff. And the other one I often get, especially post-election, now that things are a lot more friendly, because it used to be like the regulators hate this stuff. Now that that's no longer the case, the one I get these days is, what are the use cases? Why do I need to care about this, right? Like, it's like, people are like, I get AI because I see this ChatGPT thing and I use it all the time, but like, I don't touch crypto. Like, why do I need this? And that's when kind of like we started to talk about stablecoins, because I think that's a story that a lot of people can understand, and there's real tangible sort of growth levers there. But yeah, so it's volatility and a lack of understanding and a lack of ability to touch and feel the stuff. Now, if you solve for those things, which is, you're never going to be able to solve for the volatility, but if you can have, let's just say, a moment where, the use cases created by public blockchains become sort of top of mind for everyone through a demonstration of why this is important, then you could see this sort of stampede type effect where like everyone is not allocated to spaces. You know what, I want to allocate right now. I need to put X amount of work. And then all of a sudden you kind of get like sort of everything goes up type environment because there's so much capital coming in. But we're so far from that. We're not even anywhere close. So yeah, I would say low odds for something like that happening. But again, like, one thing I'd say put out there is, there's been headlines that DOGE and Elon want to put a lot of the government's transactions on a public blockchain. Something like that where it happens and the rest of the world sees the benefits of public blockchains and what it can do for transparency and cost. That's like one of those moments where things become so obvious. So again, I don't know how close we are to that. I don't see it happening anytime soon, but just something to think about.
Hey folks, I want to tell you about our sponsor, Gearbox, the protocol that reimagines on-chain lending. With Gearbox, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about Gearbox, go to gearbox.fi.
Egg. A quite astonishing commodity. The cause of your desire. Egg. Which fills the inner void. Egg.
Eggs are pretty epic, but you know what's more epic? Paying for them with crypto. Borrow, earn, and now pay with MOONWELL.
Say hello to Puffer UNIFI. Puffer Finance is expanding beyond native liquid restaking with new products such as UNIFI-based ROLLUP and UNIFI pre-confirmations AVS. UNIFI is not just another L2. UNIFI is a based rollup, one that will solve L2 issues, such as slow withdrawals versus instant withdrawals with Puffer UNIFI. Puffer UNIFI is fast, capable of sub-second transactions. UNIFI also has boosted Puffer points, which means if you bridge assets, you earn boosted Puffer points and rewards from dApps on UNIFI. Puffer's core products mean a bright future for Ethereum. Learn more at puffer.fi. Before we move on to the impact of stablecoin regulation coming and how we can potentially, I guess, like invest in a market where we believe that stable coins are the future. I do want to get your thoughts on like, what's the lesson that we take from what's happened with this blow up with the LIBRA token? Like, I guess as someone who wants to invest long-term in crypto, who has like a long-term time horizon, who wants to invest in tokens that represent fundamentally strong teams and protocols and communities that are going to stick around, like, what are we supposed to take from this? Is this just bull market bullshit that happens and you're supposed to like filter out this as like noise? Any other thoughts you have there?
So I would sort of separate the issue into maybe two things. The sniping and like sort of this insider grift that has come to attention that people are like now really mad about. I think we need to get that stuff out of the space, right? I think there has to be more honesty and integrity in even in the meme coin world. Just because it's, you know, whatever, it's a quote unquote collectible, whatever people like to think, that doesn't mean you could have a sort of a, you know, fraudulent environment for people, because then nobody wants to come explore that. So that has to go away. But I personally have not been as negative on, let's just say, creator coins, right? Because we originally was like, this all started with meme coins like WIF and whatever else. But kind of since Trump coin launched, we've kind of started to see folks explore the creator coin world where, you know, you've seen some celebrities come out and say, here, you know, here's my coin or whatever. Even though it's been sort of, again, sketchy celebrities, you're seeing folks explore the design space of what's possible. Like, when I think about that, a lot of creators run great small businesses that could probably never go public, but also have a great following, right? Just imagine, you know, you guys, I mean, I don't know, you have 50,000 followers on YouTube, something like that. I imagine, I don't know if I'm quoting that correctly, but I assume that you guys have a great business, but I also would assume that you're not anywhere near being able to go public into the stock market and then doing an IPO, right? Your business value has to be $5 billion plus today to go public.
We're not quite there. Not quite there yet.
Yeah.
Close, but not quite.
We're grinding.
Well, I hope you get there.
We'll get there maybe someday, yeah.
I mean, with merch like the hat, you definitely get there.
This is it. I'm gonna need to. By the way, if anyone's wondering, this is from a brand called Dad Brand. It's awesome. They should actually sponsor the show because I wear the hat in every single show. So
yeah.
Anyway, sorry, Pranav, you were saying
you could give a hat out to all your guests. I would love one.
Exactly.
Of those. Exactly. Yeah. So I think where it was generally going was small businesses like yourself and other creators being able to have a token, then figuring out could they have some value accrued to that token from their small business where those things attach, and then the folks that support you to that token are your followers, but then they get to also kind of economically participate in your success. And again, all this under this sort of regulatory framework of is this allowed or not? Like, I'm not going to, sort of comment on that, but I think directionally where the SEC and the Crypto Council, all these people are heading is potentially allowing for things like that to happen, where you guys can have a token and have straight up value accrued to that token. You'll have some light touch reporting requirements and those types of things. I think that's directionally a good place, right? I think a lot of the creators would choose to probably launch a token without any value accrual, essentially a meme, and then over time be less and less of a meme and something that has real fundamental value. Because like, you don't know what's going to work and what's not going to work. You need sort of room to experiment for your asset there. So again, I think that's all a good thing. And I think in a way the Trump coin sort of opened up the doors for things like that, right? It said, all right, guys, go experiment. But I think the whole sort of how these things are launched, as we're learning, is very sketchy. That needs to be fixed.
Yeah, I do want to remind people that I think the reason we're at this place with meme coins is that there was never any clarity provided for how to launch a token for, legit protocols and businesses and creators. And so they left this gap, and meme coins is like one of the ways that folks saw to circumvent that. So, I blame a lot of issues still on like the failings of like a Gary Gensler, and, thank God he's out now. But speaking of regulation, why don't we talk about stable coins then? So What is coming in terms of stablecoin regulation? Like, we hear that there's a lot of promising like new policies or regulation coming. I guess first off, like what are your thoughts? What's your like summary there of like what we might expect? And then I'd love to talk about maybe like what are the opportunities that we might be able to invest in or, look to invest in, because something like Tether or Circle that makes up such a big component of the stablecoin market, neither of those companies are investable for, even institutional investors right now. So, let's start though with like what's coming.
Yeah. So, my general expectation is we'll get stablecoin legislation done at some point this year, if not, in the next several months. And I'll kind of tell you without getting into like the nitty gritty, because the bill is out there, or at least the proposed bill is out there, and anyone can read it. But I think I'll tell you the practical implication of that, which is I generally think US dollar stablecoins have been a finished product for some time. Even before this legislation stuff got into the mainstream conversation, there's over $150 billion of kind of US dollar stablecoins out there. It was in the hands of over 90 million people. Now it's mostly people outside the United States. And it was serving a need, which was it was giving people access to dollars where, they have currencies and local economies where they don't want that local currency. So it was solving that need. Now, the next need to solve was commerce. And because using stables to settle transactions is just better, faster, cheaper. Everyone's kind of talked about that. And you can do the unit economic math and say, if, for example, Airbnb as a company was getting paid in stable coins versus credit cards, how much money could Airbnb save, right? The number is pretty big. You can do that for any business. So the thing that was holding back the payment adoption was a lack of regulatory clarity. So, you would talk to businesses that would truly benefit from this, and you would say, okay, we both agree that this could save you a lot of money and time. Why aren't you doing it? And they would say, well, I don't want to get sued because I don't know if I'm allowed to do this, right? When it's like something in the gray, then people who have a business that does whatever their core business is will not choose to experiment with this. So I think getting a bill done through Congress that's signed into law will kind of give the green light to, let's just say, the Fortune 500 companies to try and figure out how they can leverage stables to improve their cost structure. And that in turn will, again, increase the amount of stable coins in circulation and then velocity that will create potentially new businesses, right? Because, a lot of big Fortune 500 companies can free up a lot of working capital by having instant settlement than T+3, T+7 settlement. So if there's working capital savings, well, what else could they do with that capital? So there's a lot of sort of compounding effects from that. And so the way we're thinking about it is there's probably in the next 2 years, there's probably two avenues to kind of think about. Number one is if you kind of pick a list of internet companies and e-commerce companies and go through their business models and you ask, is this a business where a big cost are credit card fees? And you can kind of dig through financials of these companies and say, okay, and you'll make a list. I think you'll end up with a list of probably 20 large public companies where interchange fees, aka credit card fees, is a very large cost line item. Then the question is, can this company figure out how to leverage stablecoins in a novel way where they can start to eat away at those costs? A lot of times it's going to be hard because, getting the consumer to get stables and then pay with those stables is like a very hard thing to do. And at the same time, you ultimately need a kind of like a visionary founder, CEO who's willing to innovate not only at their business level, but along with stables to then really solve for that. So you'll have a shorter list, but I think the biggest opportunity is identifying a list of companies that could use stable coins to just massively improve their own cost structure. And as a result, see bigger cash flows and get a margin uplift and get a multiple uplift in the public equity markets. And this area is something that, most people aren't paying attention to. And I think if you can identify 3, 4, 5 winners, that's going to be huge. So that's one area we're focused on. I'm not going to talk about any individual companies, but I'll generally say, look at internet companies and e-commerce companies because the numbers tend to be big. And for those businesses, they're all digitally native anyway. So figuring out a change in behavior with stables rather than credit cards is easier to accomplish. So that's area number one. Area number two is obviously last I checked, it's probably 100 million people, give or take, that have US dollar stablecoins in a wallet somewhere in the world. Again, 5 billion people with an internet connection, 100 million people own stables. It's easy to imagine that 100 million number growing to 1 billion over the next couple of years, especially outside the United States. This is, again, not for people in the US, but, folks outside the US, right? I'll give a simple example. So Nubank, public company in Brazil, it's a fintech. I believe they have close to half of Brazil's population on the Nubank app. I think of it as kind of like a Robinhood meets like a JP Morgan type thing. They enabled their Brazilian customers to have USDC in their Nubank app and earn, some interest as by part of holding it. And they had a pretty successful launch, it seems like, right? Because people in Brazil are like, oh, you give me dollars paying interest? Love that. Would love to have that, right? So that's a trend that is kind of undeniable and it's going to keep growing. So the question there is, you think of on-chain businesses, right? Ignoring the public companies as I'm from the prior conversation. The question is like, once you get stables in the hands of people, what do they want to do with it? Today, there's probably only two things they can do with it, which is earn T-bills through some tokenized T-bill product. And the other one is, go trade meme coins and trade some volatile tokens. So I think that gap will get filled, i.e. you will see more and more traditional products that are sort of in different parts of the risk reward spectrum show up on chain. So I think, private credit has already started to show up on chain. You'll see tokenized equities on chain at some point. So, you'll have tokenized Apple and tokenized whatever, Amazon, all these things on chain. And you'll see other sort of interesting business models where, maybe you can earn returns slightly better than T-bills for very little risk, but there's some risk. So there's sort of a sweet spot for that risk return profile. So I think that's what people generally like to call RWAs, right? So I think in the token world, finding projects that are enabling that are equally interesting.
Pranav, I think you laid out a really interesting framework for people to look at, like how they should look at the public equity market right now. And I think if you read the tea leaves, or if you're somebody that pays any attention to like earnings calls or just kind of like some of these big information days with companies, it kind of becomes clear. Like one example is, I think it's Vlad from Robinhood. Recently, I think it was around their earnings call, he basically talked about how, they're already using stablecoins on the back end for efficiency gains. So he's clearly not worried about waiting for regulation. He's kind of like outwardly saying, I think I feel safe enough now with what I'm seeing coming down the pipe. Hey, we're already using it because it's way more effective. So yeah, looking at players like that, I think is really smart. Like another one, I'll just throw out another name. This is a pretty obvious big one that we heard a few months back, but Stripe acquiring, I think it's called Bridge, or was it Bridge that they acquired? Yeah. So, I mean, that's like another pretty obvious indicator of how serious they're getting in the space. But
so that's actually, you bring up a great point, right? One of the ways we looked at this was, who are Stripe's most innovative partners in the public markets that can now leverage what Stripe has done with Bridge? That's, if you can explore that question further, you'll end up with some list. And on the Robinhood point, one of the things we noticed was Vlad and team, as early as last summer, really start to lean into crypto. I think he did this podcast interview last summer where he talked about tokenization as an opportunity. And so I would think that they were focused on this maybe last summer. It kind of took them 6 months plus to kind of get there. But you'll have a whole list of companies that were not as early as Robinhood that are now starting to work and will probably get there in the next 6 months. And then you'll start to see it in their numbers, soon after, right? And Wall Street only appreciates these stories once you start to see it in those numbers. And so I think there's a decent bit of time where you can do some real deep work and figure out who could really leverage this stuff.
Yeah, great point. So you were starting to kind of allude to the on-chain opportunities here. I know you can't maybe mention specific names, but can we just dive a little bit deeper into that framework that you're applying for some of these obvious RWA or on-chain stablecoins that already exist? And do you see long-term staying power and potential with teams that emerge from the on-chain world first and then maybe try to penetrate out to that Web 2 ecosystem? I'll throw out a name, but like I'm looking at things like Athena is like, a pretty big innovator and player in the on-chain world.
Yeah, so this is an area we're still kind of debating as a category, which is people have created a lot of these RWAs in crypto, but most of the people that are using these products today are the ones that have to figure out how to use like, Phantom Wallet or MetaMask or whatever, and then access these products by the ways we've all been accessing crypto for the last several years. But I don't think the rest of the world's going to approach it that way. I think ultimately it'll have to be a curated experience where it's going to be someone cherry picking what are some safe, high quality products to then serve the end user that has stable coins in their wallet, right? So if I'm someone sitting in Brazil, I have the new bank app and I have USDC in that wallet, then I don't know if that person wants to like run around, go on DeFi Llama and figure out which protocol, which DeFi app they want to use. I think that has to be served to them. So the question we've been debating is if that's where we end up, where like sort of these front ends, fintechs serve these on-chain RWAs to the user, then the actual kind of bets become around who's got the best on-chain product that's safe, secure, and has a founder that can do really good BD to then get those fintechs to use them. I don't know if that makes sense. And then that kind of becomes a little bit of like a winner-take-all type market, because once you can get a fintech to use you for, let's just say, a set, whatever product, then you can also build other product lines and then serve the same need. Because most fintechs probably don't want to deal with like 100 different vendors for different things.
Pranav, I saw on your Twitter or X, I still can't call it X yet, but a while back you were weighing in on the AI agent Meta. I'm curious, like, what you think of it now, and is it an area you're interested in? Do you think it has staying power?
Yeah, so I think it's actually an area where the intersection of crypto and AI makes more sense than this whole thing we used to talk about with like decentralized GPU clusters and so on. So here's why I think it kind of makes sense, like just philosophically, which is it seems like the next evolution to all things in AI are agents completing tasks for humans, right? So if I'm trying to plan a trip for this year, I want an agent to tell me based on my, historical travel patterns of what I've liked, disliked, to tell me where to go and make all my bookings, complete all the tasks for me so I don't have to do any of it. Again, as an example. And there's going to be tons of teams that are going to be competing to build the best travel agent, for example, or best tax agent or best legal agent, whatever you want to call it. And ultimately, those agent teams are probably not going to be big. They're going to be small teams. They probably won't need a lot of venture funding. And at the same time, they'll end up being small but really interesting high-margin businesses, but they're not going to be multi-billion-dollar businesses again that can go public one day. So the logic here would be that the token markets could be good exits for a lot of high-quality agents. So, team builds an agent, agent's being used, the team probably needs to exit or get some liquidity, and launching a token for that agent will make a lot of sense. And, folks will be able to get the economic returns from that agent itself, and then the team can move on and go build the next thing. So that kind of generally makes sense to me where I see the opportunity set. So far, I don't think anyone has kind of nailed that agent. Most of the agents that exist today are either providing you some information about the markets in crypto or is trying to entertain you. Both are kind of interesting, but like nothing groundbreaking. I would love to see a agent or a group of agents, I think they call them swarms, complete tasks for you. And when we see something like that happen, that again should inspire other folks to then sort of iterate around that. So we're waiting for that moment to happen, but I think it probably does. I think, I've met a lot of people in the AI agent category that are working on interesting things. And so the probability that something useful comes out of it is pretty high.
Yeah. One thing with AI agents, and this is from I think my own experience thinking about actually the way Nomadic and I have to interact with folks who are interested in the content we produced. We learned about virtuals, and this was one of the earlier AI agents called Luna. And that idea that Luna could basically stream 24/7, that was really powerful to us. And actually, if anything, it was a little scary to think wow, if someone really finds that to be as entertaining, as valuable, there's just no way to compete with that. So then if you expand upon that and you have all these AI agents that can, of of course, operate 24/7, 365. Now all of the associated economic activity that goes with those agents also jumps. And so then I get excited about going back to stable coins, like all of the activity that's going to happen. Like we've already seen growth on chain with all of the different metrics this cycle. It's probably been one of the few clear wins this cycle. Just like numbers just keep going up on chain. DEX trading volume, all of that, perps trading volume, stablecoin trading volume. And so anyways, just very excited for what AI agents will bring in terms of economic activity. It's just they need to find their clear product market fit. They need to get better at providing value that can stick with us over the long term. That's not going to be this like fleeting speculative cash grab that comes and goes really violently.
Yeah, that makes sense. I think, like I've seen some things on Twitter recently about different sports betting agents, right? I like to bet on sports. I'm not a big, consumer of sports without the betting component because I think, that's the only thing that makes it interesting for me. But the way I do my research these days is really I use like Perplexity to kind of ask about, let's just say, if I was curious about the Super Bowl and who to bet on, I would be kind of using Perplexity to research the teams, the players, and sort of how things can play out. But if there was an agent that sort of completed a lot of the manual work I'm doing back and forth, that's pretty useful. And I might be willing to pay a subscription fee for that agent itself for providing me something that's useful. And that agent theoretically should have a token or could have a token and then sort of live in continue to live and sort of drive value to its owners and as well as the people that created that agent itself.
I want to go back to our conversation on altcoins before we wrap up. Just one last point. What are your thoughts on new ETFs coming? Like, I think the top most likely to be approved ETFs seem to center around like SOL or XRP or maybe even DOGE. Nothing to do here with like price performance around these assets. I'm just interested in, will ETFs for major altcoins like that potentially bring more liquidity on chain? Like, does that have like an after effect of like seeing lots more liquidity come on chain and maybe us getting to a place where there's just that much more interest in other tokens, like let's say the top 100 that you referenced earlier?
Yeah, so I think you'll probably see a lot of single token ETF applications, and there'll be several that probably get approved and come to market. But I think, selling those products to the end users is going to be tricky because, each individual token ETF becomes a separate investment decision for the end user. And that's hard to underwrite for a lot of people. Because imagine you already have the ETH spot ETF, but then you have 3 other L1 token ETFs. And now you have to sort of try and convince someone to allocate to one over the other. How do you then decide sizing? And then sort of it creates a lot of confusion. I think where ultimately things make sense is having essentially an S&P 500 equivalent for the token market in an ETF wrapper. So, there's different indices you can pick, right? You can kind of do top 50 market cap weight. You can do one without Bitcoin. You could maybe exclude meme coins. You can kind of pick your flavor, how you want to do this. Again, you need more clarity on tokens and market structure for that. You might need Congress to act before you can have a product like that. But I think that's where things will end up in the future, which is a multi-token sort of S&P 500-like ETF for the token space, where someone can wake up and say, you know what, I want my crypto exposure, I buy this thing. People just want to make one simple decision. They don't want to sort of do all this analysis.
Do you think the missing sort of index of, top altcoins, is that potentially why there hasn't been as much interest in the ETH spot ETF? Actually, I can back up to and just maybe let you give your thoughts on this. I feel like there's like very mixed reviews on this. One day you hear folks, talking about the inflows into the ETH spot ETF relative to its market cap, which is much smaller than Bitcoin, being impressive. But then I think when you look at the absolute, amount of money that's gone into the ETH spot ETFs in comparison to the Bitcoin, like obviously, like we look at Bitcoin and go, wow, like there's just so much demand there. I'm thinking like, is there a lesson in all of that for future ETFs? Like, is the ETH ETF a success and just it's going to take time for that demand to grow?
Yeah, I think if I were to separate the two, digital gold is a easy story for people to understand. They might hate it, they might not like it, right? There's several people in the world that don't see the point in owning gold. I think Warren Buffett doesn't like to own gold. So either you want digital gold or you don't. And that's easy to make a sort of understand what this is. When it comes to ETH, it's got competition. It's got this L2 roadmap that seems to be cannibalizing on fees. So there's a lot of complexity to the story. And so the more someone has to think about something and there's more ways they can be wrong, then they'll choose to not make a decision on that yet. So I think those two components probably mean that explains why the Bitcoin ETF has been more successful if you're purely to measure from the perspective of price performance. I think the other thing people often do is they might confuse the ETF inflow number to success. And I think the one thing to think about there is there are a lot of folks in the TradFi world that are doing the cash futures basis trades. So, buying spots, selling futures. And a lot of those things can also be driving flows. So just because you see inflows doesn't necessarily mean that's a directional inflow. It could be someone doing a delta neutral trade somewhere. So that's another one to kind of just think about.
No, all great points, Pranav. And I think this is a great place for us to start to wrap up, guys. So I want to remind our listeners that they can first learn more about VanEck by going to vaneck.com. They should follow the Twitter account for VanEck, which is VanEck_US. And then follow Pranav's personal account, which is VanEck PK, just his initials there. We'll put that all into the show notes so you can easily find it. And then Pranav, thanks so much for coming on. This was such a great conversation. Really a conversation that like we needed to have. I think it helps me to think more about like what's happening in the markets, what's likely to happen here in the next few years. I mean, it's been a rough few months for crypto. And I mean, I remain super bullish, of course, on the space. And again, I think you have to really zoom out and think, all right, like, where's the puck going next? We've had a lot happen over the last few years. I don't know if, the bull run continues or if we've already topped out, but I'm always thinking in like 4-year cycles at least. And so there's just a lot here that you've called out with stablecoins and altcoins and thoughts here on the ETF and future ETFs. But I want to give you the final word. Anything else you'd like to share before we go?
Yeah, so maybe I'll leave with one thought, which is I separate price, obviously, from fundamentals. And so on the fundamental side, the one thing I'd noticed in the years of 2022, 2023, and 2024 to the first half of even 24 was the following, which is, we go to all the crypto conferences and I just generally noticed a lack of new intellectual capital coming into the space. It was the same founders telling the same stories and, half the time stories made no sense. And this is, even in 24 prices were going up, but it was like there was nothing net new that was interesting. And a lot of that was because you were not seeing net new founders come into the space to explore and sort of try new things, all as a downstream effect from the regulatory environment that we had. Since the election, I think that's changed a lot. There's a lot of interesting things happening, but they will take time to come to market. And so we see this, on our own venture side. As I mentioned, we have a separate strategy that does pre-seed and seed venture. We see some really interesting founders coming in and then building really cool things. It will take time for those things to come to market. But I'm personally more optimistic today on sort of going back to like the probability of success for the space than I was, 3 months ago, maybe when the prices were even higher.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And to stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.